Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Common Causes of Economic Crises. Economic crises are periods of severe economic downturn characterized by significant declines in economic activity, income, employment, and trade. Understanding the common causes of these crises is crucial for preventing and mitigating their impacts. Various factors can contribute to economic crises, including financial imbalances, policy errors, external shocks, structural weaknesses, and psychological factors. Financial imbalances, including excessive debt accumulation, asset bubbles, and banking sector vulnerabilities, are a primary cause of economic crises. Excessive borrowing by households, firms, and governments can lead to unsustainable debt levels, making economies vulnerable to shocks. For example, the 2008 global financial crisis was triggered by a housing bubble in the United States, fueled by subprime mortgage lending and securitization. The collapse of the housing market led to massive defaults, causing financial institutions to incur huge losses and leading to a credit crunch. Asset bubbles, where the prices of assets such as real estate or stocks rise rapidly and exceed their fundamental value, can also precipitate crises. When these bubbles burst, they can cause significant wealth losses and destabilize the financial system. Policy errors, including both fiscal and monetary policy mistakes, can exacerbate economic crises. Fiscal policy errors, such as excessive government spending or inadequate taxation, can lead to large budget deficits and unsustainable public debt levels. This was evident in the European sovereign debt crisis, where several countries, including Greece, faced severe fiscal imbalances due to years of high government spending and tax evasion. Similarly, inappropriate monetary policy, such as keeping interest rates too low for too long, can fuel excessive borrowing and asset bubbles. Conversely, tightening monetary policy too quickly can stifle economic growth and lead to recessions. The Great Depression of the 1930s was partly attributed to the Federal Reserve's failure to provide adequate liquidity to the banking system, leading to widespread bank failures and a severe contraction in economic activity. External shocks, such as sudden changes in commodity prices, natural disasters, or geopolitical events, can also trigger economic crises. For instance, the 1973 oil crisis, caused by the OPEC oil embargo, led to a quadrupling of oil prices, resulting in stagflation, a combination of high inflation and stagnant economic growth in many advanced economies. Natural disasters, such as earthquakes or hurricanes, can cause significant economic damage by destroying infrastructure, disrupting production, and displacing populations. Geopolitical events, such as wars or political instability, can also lead to economic crises by creating uncertainty, disrupting trade, and deterring investment. Structural weaknesses in the economy, including poor regulatory frameworks, lack of diversification, and rigid labor markets, can make economies more susceptible to crises. Weak regulatory frameworks can lead to inadequate oversight of financial institutions and markets, allowing risky behavior to go unchecked. The Asian financial crisis of 1997-1998 was partly due to weak financial regulation and supervision in several Asian countries, leading to excessive borrowing and risky investments. Lack of diversification in the economy, where a country relies heavily on a single sector or commodity, can also increase vulnerability to external shocks. For example, countries heavily dependent on oil exports, such as Venezuela, have experienced severe economic crises when oil prices have collapsed. Rigid labor markets, with inflexible wage structures and employment regulations, can hinder the economy's ability to adjust to shocks, leading to prolonged periods of high unemployment and low growth. Psychological factors, including herd behavior, speculation, and loss of confidence, can amplify economic crises. Herd behavior, where investors and consumers follow the actions of others rather than relying on their information, can lead to market bubbles and crashes. Speculation, where investors buy assets with the hope of selling them at higher prices, can drive up asset prices to unsustainable levels. When speculative bubbles burst, they can cause significant financial losses and economic downturns. The dot-com bubble of the late 1990s, driven by speculative investments in technology stocks, is a prime example of how speculation can lead to economic crises. Loss of confidence in financial institutions, markets, or the government can lead to panic and capital flight, exacerbating economic crises. During the 2008 financial crisis, the collapse of Lehman Brothers led to a loss of confidence in the banking system, causing a global credit freeze and deepening the economic downturn. In conclusion, economic crises are complex phenomena with multiple causes, including financial imbalances, policy errors, external shocks, structural weaknesses, and psychological factors. Understanding these causes is essential for policymakers to design effective measures to prevent and mitigate economic crises. By addressing financial vulnerabilities, implementing sound fiscal and monetary policies, diversifying economies, strengthening regulatory frameworks, and managing psychological factors, policymakers can reduce the likelihood and severity of economic crises. The lessons learned from past crises, such as the Great Depression, the Asian financial crisis, and the global financial crisis, provide valuable insights for building more resilient economies. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.